Good morning and welcome to another edition of the Main Management Weekly Market Note for the week ended February 20th, 2026. We had a lot of data last week, quite a bit after I think the week prior was not a whole lot. We didn't do a podcast the week prior, but this past week, quite a bit of macroeconomic data on top of, just the regular goings on. On a performance basis, the week was broadly positive. You've had some chop in the last couple of weeks. It was nice to see kind of the broad indexes on the bottom left there, basically all up across the board for that trailing week. And on the right, you can see the sector performance. Only staples was in the red. Year to date, staples are actually positive, up 13%. But financials are the laggard and tech as well on that kind of software apocalypse. People are calling it SaaS apocalypse.
You keep seeing, I'll keep mentioning it, this pro-cyclical kind of move on the left-hand side, those indexes for the week, commodities, emerging markets, small cap, all very much that cyclical, economically sensitive areas, kind of global economically sensitive. And then on the right-hand side on the sectors, industrials, utilities kind of in the middle of the road there, but comm services and energy, both of those, again, kind of pro-cyclical. So it's reiterating that rotation narrative.
Yep, indeed. Certainly seen some changes under the covers here. On the recession dashboard, not a ton's changed from the last week. The big news on the week, probably the biggest, most important was core PCE for January. That's the Fed's preferred inflation measure. It came in at plus 0.36% month over month, which is slightly above forecast for a 0.3 reading, but not huge. I think people had kind of looked through the CPI and the PPI releases from earlier, and it kind of said this might be a little bit hotter, but nothing huge here. The year-over-year figure ticked up to 3%. That's the highest since April of 2024. So that'll make people kind of, a little bit afraid of a reinflation narrative. But at least, kind of for the time being, it's not a huge development. I think it doesn't really change a whole lot on the Fed, the outlook, 2 cuts this year still. But then within the PCE breakdown on the right there, you can see services have been holding steady around 2.5 to 2.6% year over year, while goods are now down year over year. They're down to minus 0.11%. It's the most negative since March of 2023. So you're definitely seeing kind of a bifurcation between goods and services on the pricing side of things, with goods being at this point deflationary and services continuing to grind higher. On the income and spending side of things, consumer spending was up 0.42% month over month, basically in line with forecasts. That year over year is going to make people worry a little bit. It's down to 4.68% month over month, which is the lowest since January of 2024. But some of the more timely or frequent, like Red Book retail, for example, has been up around 6.6% for the last 3 months. That's weekly data ongoing. So that's kind of, to us, that says, there's, indicating kind of continued decent spending. There are different methodologies, which clearly accounts for some differences there. But I think the point being is that there are multiple places where, you can kind of look and say, all right, as we piece together this whole consumer spending place, it seems like it's chugging along pretty okay. Incomes were up 0.33% month over month, and basically unchanged year over year at 4.3. Again, still, even with that 3% core PCE, it's still more than 1% above inflation, kind of regardless of which measure you use. So real income gains are still occurring. And those income gains were driven by $38 billion increase in personal current transfer receipts, $23 billion from wildfire, and $15 billion in government social benefits. One thing we did look under the covers kind of internally, and unemployment insurance continues to be negative, which is a good thing. You don't want to see that start to tick up because that means more people are filing for it. So seeing that continue to be down is a positive indicator for the labor market. We got the preliminary reading for Q4 US GDP. It came in like half of forecast at 1.4 quarter over quarter annualized on the left there. The Atlanta Fed now casts at 3%. So pretty solid miss, but I think the main reason for this was the government shutdown was a larger drag than people had anticipated. It took over 1% off the top line, around 1% off the top line figure. As a result, though, some forecasters have already kicked their Q1 2026 estimates up, citing kind of a reversal of the shutdown effect. Although we're back in shutdown now with you're seeing, global entry shutdown,
the TSA things.
TSA, hopefully not an issue yet. But again, this government just can't figure out a way to kind of get things going for an extended period of time. Will be interesting to see what the State of the Union brings tomorrow with another shutdown going on. On the right, you saw consumer spending that slowed to 2.35%, but that's still, basically only slightly below the average
Yeah.
over the last couple of years. So again, to our point, kind of continuing to chug along in there. And again, as with this GDP numbers, all this stuff is we've already lived through it.
Yeah.
Markets are forward looking. This is all very much in the rearview mirror. This is 2.5 months old data for Q4. So people are going to kind of say, oh, it's slower.
Yeah.
It's like, we've already moved through it.
One of the ways I think about this too is, and you kind of alluded to it, the government shutdown or, lack of government spending contributing to GDP is more like a one-off thing that gets reversed or, accelerates in the next quarter. If it was something like consumer spending collapsing or something that's more a longer-term trend coming down, we'd be more worried about it. But this is probably more of just a one-off issue.
Yeah, I think so. On the government spending, you can see on the left there, it fell 5.1% Q over Q, and that was it took 90 bips off that headline GDP as far as kind of the different components and their contribution to it. But outside of the pandemic kind of distortions, that's the biggest quarterly decline in government spending since Q3 of 2011. When we were coming out of the financial crisis. It was a pretty solid drop in government spending. And remember, it was a couple, multiple week long shutdown. On the right, you can see a few major components share of GDP. Government spending, again, that purple line on the right there is now down to just 16.4%. So that's a record low. And I think that's a good thing. You don't want the government to be driving GDP growth. You want private industry to be driving that. And because it's given, regardless of your stance on any administration, I think private industry has clearly shown that it's better allocator of capital than the government is. And then I guess as a few of the releases or analyses of the release noted, in particular, we saw a solid quarter for final sales to private domestic purchasers. So that's a good sign. The Fed will likely see that as kind of a signal of resilient ongoing demand. So under the covers, still solid demand, which is kind of the good news of this release, even if the headline was a miss. On the durable goods orders side, they were down 1.4% month over month. That was better than forecast for a 2% decline. The overall drop was driven mostly by a 5% decline in transports, which tend to be more volatile. Overall, year-over-year figure ticked down to 10%, but that's been trending higher over the last year and a half or so, kind of choppily. And then orders for core capital goods, which are non-defense capital goods, ex-aircraft, those are a closely watched business spending proxy. And those were up 0.57% month over month. 6 straight monthly gain. That's a good, again, another kind of, the headline missed, but the underlying, the core number that excludes some of those really volatile transports is up to 5.9. That's the second strongest year-over-year increase since October of 22. So you can see both of those kind of choppily trending higher over the last 18 months.
On the right-hand side there just how much it's moved up over the past couple of years. It's strongest in, as you mentioned, a few years now.
And it was at almost negative 5% in kind of mid-2023. So it's good to see that steadily accelerating. On the industrial production side of things, we got off to a pretty solid start here for January, up 70 bips month over month. That's the best since Feb of 25, and almost double forecast for a 0.4% gain. Year over year is up basically 2.3, which is, again, the best since, September of 22. Manufacturing output also was up 0.6. Very similar. Beef forecast for over 0.4, best since Feb of 25, and it's now up 2.6 year over year. Again, the best since 22. So it's good, encouraging readings to start 2026. Where you can see here the monthly numbers. There's been chop along these. That's not entirely surprising, but you kind of want to see that year over year trending higher, which it has been.
I'll say one thing. I don't think it's a coincidence that a lot of these cyclical sectors, your industrials, materials, et cetera, have been doing well this year, and you see these economic readings on industrial production, on the core capital goods, a lot of these business spending kind of hard asset type of proxies doing very well year to date.
On the looking through the covers a little bit, we saw capacity utilization improved up to 76.2. That's the best since June of 24, but slightly below forecast for 76.5. Again, we'd like to see this kind of start to ramp back up, but there's as with most things, there's the numerator and the denominator part of the equation, and having those both move in the correct direction to drive it higher can be challenging. On the right, this is the high-tech components within industrial production. All of them were up month over month. This chart is year over year. So you can see they're kind of decelerating here almost across the board, except for like software and peripherals. Peripheral equipment, sorry. But the point being is this is off of tougher comps. So it's not as if they're slowing down on a month over month basis. You're still seeing continued growth. But when you have these kind of outside comps and strong growth over multiple periods, especially when you get into the 12-month, 24-month over, year-over-year numbers. You can get the year-over-years to start to slow because it's off of a bigger base, and that rate of change is kind of coming down. But again, the point being is they are moving in the right direction incrementally. Which is good. That comparison kind of muddies the waters a little bit, so to speak. On the trade balance, the trade deficit widened back out to 70.3 billion deficit in December, more than forecast for a 55.5 billion figure. Good news here, imports up solidly for a second month in a row. They're now up 3.6% month over month, back to basically 358 billion, best since March of 25, while exports were down for a second straight month at minus 1.7, sliding into 287.3 billion. Goods are basically the lion's share of trade. Goods imports are 43.4% of total trade, and goods exports are 28%. So between those two, you've got basically 75% of total trade is goods trade. On the right, we show those broken down by category. You're kind of seeing haves and have-nots in this year-over-year number, where capital goods ex autos are up the most at 28, and the highest since May of 21, followed by other goods up 21%. Then the laggards are industrial supplies down 24.5, and then consumer goods down 21.5. So I think part of this is also you're seeing kind of a effects of onshoring, where the administration has clearly pushed companies and said, hey, we want you to bring production back into the U.S. What is that going to do? It's going to cut down on imports because you're now not having to import anything across a border, or at least parts of the supply chain are being brought back. So I think that's kind of eating into some of these numbers in a little bit larger manner than maybe people have anticipated. On the switching gears a little bit here to the housing market, the last two slides are on the housing market. We got new and pending home sales. New home sales declined 1.7 month over month to 745,000 units, but that's still well above expectations for a 730,000 unit figure. Hopefully, they're maybe trying to break out of that sideways trend. This housing market has been kind of locked up for the last couple of years. No surprise with the high mortgage rates and people really saying, hey, you're going to make me move. It's got to be a really high price, which has hurt affordability. The number of homes for sale fell to 472,000. That's the lowest since August of 2024. And the month supply is down to just 7.6 months. That's the fewest since July of 2023. Then you had pending home sales, which dropped to a new record low on their index of 70.9. Again, just kind of showing those ongoing challenges. It's basically flat year over year, but again, are down 0.2%. But it's at the lowest level ever on that index. Again, just kind of showing the ongoing challenges. Then we got housing starts and building permits, which unexpectedly surprised the upside, which is nice. And the housing starts were up for the second month in a row. Total starts are at 1.4 million units, well above forecast as well. Single family up to 981K, and multifamily up to 402,000. Then on the right, we have the total building permits, which are up as well, 1.45 million, basically ahead of forecasts. Single family ticked down, while multifamily really drove that increase to 515,000. That's the biggest, the strongest run rate since August of 23. So maybe it's starting to break out of its range here. But again, as you can see, those lines are predominantly trending sideways. And I think the point here is it's, people are like, well, you're seeing some weak data in some points and better data in others. And it's like, well, we were seeing very weak data basically across the board. So you have to see some green shoots to start. And hopefully that's what we're getting. Although I recognize we sound like a broken record saying this for the last couple of months on the housing market. But, something that I think we've touched on as well on some, kind of advisor client calls is there are now more 6% mortgages in the market than there are 3%. So that kind of cost of switching hurdle is lower. So folks are looking at it where if they bought in the last 4 years, you have a 6-7% mortgage. And even now there is the option, you can refinance. I've talked to friends who are like, well, we bought it, we had a 3%, or we bit the bullet and just bought at 8% thinking, okay, we can refi in a year or two. If we can just cover that for 2 years, then we can refi to a lower percent APR, and go from there. So
it feels like, when you have this major change from a decade of 3% mortgages going to, 6+%, it's going to take time to chop through all that wood to get through that and actually have the market normalize in a kind of traditional way.
Yeah, exactly. In summary, we won't touch on every single one of these, but Corp EC up basically a bit above forecasts. Nothing too concerning there. Spending and incomes were up solidly, kind of in line with expectations. Q4 US GDP was the big hit, coming in at basically half at just 1.4. But again, that's because the government shut down. Durable goods orders were hit by transports, but core capital goods were solid. Industrial production, manufacturing output solid. Trade balance widened as imports rose again. kind of a reshoring, onshoring story there. Then, again, mixed data in the housing market. New home sales above forecast, pending home sales record low. Housing starts, building permits and above expectations. So hopefully trying to see maybe a turn here. This week it's kind of a lower level on the macro data volume. But we got factory orders, home price indices, so S&P and S&P Case-Shiller, and then you've got the FHFA for Fannie and Freddie. Continuing and initial unemployment claims, Kansas City Fed, and then the big data is at the end of the week on Friday with headline and core PPI and construction spending. But that's it basically for the week. Thanks for getting back in with us. Hope everybody had, for those who celebrate, a nice ski week, and we'll talk to you next week.
Thank you.